Imagine waking up one morning to see Bitcoin, the world's most prominent cryptocurrency, suddenly plunging 8 to 10% in hours. For many, that's nightmare fuel. Today, we'll unpack how such crashes happen and what usually triggers them. A sudden downfall is typically a sharp drop in price over a short time, hours, or a single day, often triggering panic, cascading liquidations, and big losses. For example, Bitcoin recently dropped toward $105,000 before rebounding, and in that collapse, over $3.3 billion in leveraged positions were liquidated in just 1 hour. Because many traders use leverage borrowed capital, even a relatively modest move can trigger automatic sell orders that amplify the fall. Here are the main drivers that often combine to produce a sudden collapse: macro, global shocks, and policy surprises. Unexpected geopolitical or economic news can spook markets. In one recent instance, Bitcoin's drop was tied to the US announcing a 100% tariff on Chinese tech exports, rattling risk assets broadly. Central bank moves and monetary policy like interest rate changes also matter. If expectations for rate cuts fade or inflation remains stubborn, capital can flow out of risk assets like crypto. Leverage and forced liquidations. Many traders open leveraged long bets expecting prices to rise. When price drops even a little, margin calls force positions to be closed, which adds further downward pressure. Because crypto markets are less deep, thin order books relative to size than large equity markets, big sells have bigger effects. Profit taking and sentiment reversal. After strong upward runs, some investors take profits, creating sell pressure. When sentiment shifts, that can cascade. If many traders or institutions suddenly lose confidence due to news uncertainty, they may exit or reduce exposure. Correlation with traditional markets, risk off mode. During periods when equities, bond markets, or global risk markets turn sour, money often drains from risk assets, including crypto. The strengthening US dollar can also hurt crypto as it competes for investor capital. Regulatory fear, manipulation, or large sell orders whales. Sudden regulatory hints, for example, crackdowns, bans, taxation, can cause panic. Large holders, often called whales or institutional actors, dumping big volumes can move the market. Manipulation is harder to prove, but in thin markets, tactic traders can push down price to trigger cascades. Here's how events typically cascade. A trigger, for example, policy shock. Bad macro data causes a small drop. Early losses hit leveraged traders, triggering margin calls and forced liquidations. Liquidation sells push price further down, triggering more liquidations in a feedback loop. Panic sets in. Retail and institutional holders rush to exit. Price may overshoot the fundamental value before finding support. Sometimes quick rebound or stabilization happens once extreme selling exhausts itself. In the world of crypto, volatility is baked in. Sudden crashes are rarely due to one factor. They're often the result of macro shocks, over-leverage, sentiment reversal, and cascading liquidations. Understanding those mechanisms helps investors stay alert, manage risk, and avoid being caught off guard.